Hello everybody, welcome to our bonus question. This one's regarding Chapter 5's Net Present Worth unit. Let's get started. Tom, Zach, and Ed are all investors that are looking into funding startup companies in Buffalo. There are 3 different manufacturing companies, startups, in the area, and each person agrees to invest in one of the companies in hopes that their company turns the most profit at the end. So it's kind of like a little competition. Ed's a short-term investor. He decides to create a 3-year project plan with the company, Digital Machining. The projected annual income of this company is $60,000, and the yearly labor cost will total $15,000. On this project plan, there's 0 maintenance cost because it's such a short-term project. The company will give Ed 10% of his initial investment back. At the end of the 3-year project, his initial investment is $70,000. Zach is a midterm investor. He decides to create a 5-year project plan with another company. The projected annual income of this company is $50,000. Yearly labor costs will come to $7,500 and maintenance costs $12,500, but they start after the 2nd year, so you gotta watch out for that. The company will give Zach 10% of his initial investment back, and he's initially investing $100,000 into this project. Tom's a long-term investor, and he decides to create a 7-year project plan with the company Impact Manufacturing. The projected annual income of this company is $60,000. Yearly labor costs will total to $10,000, and the maintenance costs are $12,500 a year. Tom will get back 5% of his initial investment at the end of the 7-year project, and he plans on investing $150,000 into this project. Okay, at this point we're going to go through and answer the questions, so if you want to pause the video and take a look at what the question's asking and tackle it yourself, feel free. Otherwise, feel free to listen. Part A says, assuming all predictions about the company's success are accurate and that all payments occur at the end of each year, utilize the net present worth method to determine whose project will result in the most profit. The companies utilize a minimum acceptable return rate of 12%. So first thing we can do to solve this problem, part A, is calculate our MARR. Utilizing this formula here, and we can tabulate each MARR for the maximum project duration, which is 7 years. So we have all of our values all at once up at the top. So utilizing 1 plus, in this case, our 12% to whatever year you're at. So that's how you get these values down here. Okay, so now that that's done, let's move down to Ed's project plan here. From the previous description, we know that Ed gets, we know his net gains and his net losses, and that adding those together allow us to get our net cash flow. Okay, we already calculated our minimum acceptable rate of return, and that we can easily solve for our totals here. So we have our net cash flow multiplied by MARR, and that'll give us our total. So we do that for each year going through, and then we just sum these values up down to here, and that gives us a total of $109,450. Okay, now we can create this is a cash flow diagram for Ed's project plan here if you wanted to check it with yours. Down here we see that he initially invests $70,000, and then the first 2 years he's making back $45,000, and the last year he makes $52,000. This is, again, Ed's total. We're moving down to Zach's project plan, which is a 5-year plan. Same thing here, it's very easily tabulated, so you can see where all the values are coming from. Feel free to check your work here, but you get your net cash flow multiplied by the MARR totals, and then you sum it all the way down. Here is Zach's cash flow diagram, and you can see that he initially loses $100,000 and 42.5K the first 2 years, and then his maintenance costs start to kick in the next 3rd and 4th year, and then the 5th year he gets his, I believe it was 10% back after the after his investment, so that boosts his income a little bit. Moving down to Tom. Well, actually, here let's keep track of all of the totals here. So we had Zach had 109, Tom's got 160. Ed had 109, Zach had 160, and let's find out what Tom had. A 7-year project here, so same thing, all tabulated out. Oh, looks like Tom's the best. That's a shocker. So this is Tom's cash flow diagram here again. You can see a very consistent income until the last year when he gets his initial investment 5% back. So to answer part A, Tom's project has the highest net present worth, so we would choose his. Let's scroll back up to the top, see what question B is asking. Is there any reason to choose a company other than the one with the largest net present value? And the fact of the matter is, it depends on what you want to get out of your investment. So Ed has the shortest investment project period, and he will get his money back the fastest. If you want your money back the fastest, might not be the most, then you should pick a shorter project period. Also, as has a higher net present worth per year, meaning that potentially repeating this project over time, over the time period, would give him a higher total gain than Tom. So it kind of depends. It's just a conceptual question here. But yes, there are reasons that you could prefer one project over the other. Part C is asking, you plan to finance the chosen project. So this is kind of focusing back on in one of the earlier chapters, I believe chapter 1. You plan to finance your chosen project by paying half in the initial investment upfront and the other half on a loan taken out in the project. If I is 5% compounded yearly, what is the expected net profit of the company at the end of the project life relative to the investment? So let's scroll back down here. So here we can see we're splitting our initial investment in half. The full investment was $150,000. So $75,000 of it is paid up front, and then we have to find our present value of a loan that we would have. So it would be 1 plus 0.5, I believe, yes, for the interest, and then it's over 7 years. So total cost would end up being 180. Well, it's actually right here. I won't write it up for you, but it's right here, $180,532.5. So to find the total gain, we want to net all the cash flows together. The net profit is total gain minus total costs. So what we got minus our total cost, which will give us our net profit here.